it's one of the smartest things that you can do. We've talked about before that, the equity in your home for most people might be the largest chunk of their net worth.
Correct.
But we can change that by investing in some other ways too.
Correct.
So what is investing?
Yes. Well, thank you for the question. And you used, there's two different terms we could use in this realm, is saving and investing. Saving, setting aside money for just to set aside money, is typically used or defined by the word saving. But investing, actually, the only time you can use the word investing is when you have a purpose in mind. Mm-hmm. And there should be, the first component of investing is creating a goal. There's got to be a goal for a future purpose. And you even talked about your house can be an investment.
Yes.
You have a purpose for that house. Some people will buy homes over their lifetime and want to upgrade into something bigger and bigger each time, and that's an investment. Mm-hmm. Because they're using their equity to buy something larger in the future. Or maybe at retirement they're downsizing to that final property to be in something that has no mortgage at all, and that's also an investing choice.
And then other people are, as they're going, I need to have a bigger house, they're looking at ways that they can keep the previous home.
That's correct. And so then they have a rental property, which is an investment. Again, it's an investment when there's a particular goal in mind for that asset. And so that's the first step, is having a goal in mind. And then the second step is to be setting aside an amount of money, typically amount of cash, for fulfilling that goal. And that's what investing is. Now, expanding that terminology, investing is also making decisions, weighing out the risks involved in whatever asset you want to use for that goal.
Okay.
With homeownership, it's obviously real estate, and you're putting money typically into real estate. But beyond real estate, homeowners should be investing elsewhere. Our last podcast we did together, we talked about retirement planning. So you're investing for retirement. That's the goal. Most people do that in their 401ks or their IRAs, which we discussed, and they're saving in those investment vehicles. There are people also that want to invest for not necessarily retirement, but other goals they have, be it, children's college, or it could be a wedding for their children or their own, or it could be a large trip, or it could be
passive income.
It could be for passive income. And so, although we're not going to dive into the details of what all the different assets you can purchase, most people are, besides a home, they're investing in stocks and bonds and mutual funds and things like that. But the idea is that you're doing it consistently over time to reach that goal.
And time, I think, is a big part of investment.
Correct.
And, it's as we have a stock market that has gone lower, and we've seen inflation that has gone higher, we have to keep in mind that investment is a long-term game.
That's correct.
And a moment or a year or two is kind of a blip when we look at it over time.
That's right. And that's, I appreciate you bringing up time, because that's also, having a goal, but it is first part of investing, but then determining when you need the money is the second part. And with retirement, which we referred to before, or discussed before, most people have a long-term horizon or many years to save for retirement, so they can invest differently. You typically can take more risk and determine, what assets to buy. And
the more risk that you take, the higher reward.
Yes, exactly.
The less liquidity that you need, the higher return that you'll see. That's why a savings account at the bank does not pay very much of a reward, and your checking account doesn't pay anything.
That's correct, because there is no, very, very little risk there. But so those that might be investing for a shorter period of time, maybe they need the money in 10 years from now or 5 years from now, then determining what asset to buy in that investment account is very important, and it's typically going to be less aggressive or less risky, less volatile, less up and down, less affected by the stock market jumps that we see, or inflation, or whatever the case may be. There's a lot of economic factors out there that affect investments, and that's why, as you mentioned, having a focus on when you need the money, and again, the longer the term, the easier it is to weather those storms. That's also going to determine what type of asset you want to put inside the investment.
Hey everyone, this is Kenny Klaus with Klaus Team Real Estate Solutions. We know there's a lot of confusion in today's market, whether it's billboards, TV, radio, mail. Everyone's trying to get your attention. They offer one lane, where at the Klaus Team, we have over 20 different programs we can help you navigate through to find out what's best for you. And remember, we work for you, they work for themselves. We're here to represent you and make sure you have the best experience possible.
Visit us at klausteam.com/call-us-first. So how do I get started?
So getting started investing is pretty simple. I always harp on setting goals whenever I'm talking about financial planning with a client is really setting the goal. What is it that you're trying to accomplish? And then the second from that is then now we're determining how to set up an account. I recommend using a financial advisor to set up an account. Doesn't have to be me, but working with some financial professional is a good start, and they can help you determine what type of an account to set up, whether it's for retirement or for a shorter term. Or for those do-it-yourselfers out there, there are several websites out there, basically investment companies that you can go set up an account for. A lot of them are minimum of $50. You can actually put in, open an account, and then determine what type of assets you want to own inside that investment.
So that's an interesting point. I think a lot of people, when they think of investing, they're thinking, okay, I need to have a huge chunk of cash to invest, but you can open up an account with $50.
Yes, you can. Yes, as little as $50. And then what I mentioned in the last podcast is, you want to invest early and invest often. So, opening up an account, even for a teenager, you can open up an account with $50 and be putting in $50 a month. It's doing the investment often, meaning periodically every month is the ideal. So if you're just putting in every month, then you're going to be able to, it's called dollar cost averaging, but you're going to be able to put money in over time, and there's a benefit to doing that.
Yeah, now my son, he's 15.
Okay.
I think he's at least in year 2, maybe year 3 of investing. He's
Wow.
So the green light card that parents will set up little accounts for kids that you put money into, and it works like a MasterCard. And then so they can go buy things at the store and learn how to control impulses.
Yes.
And be able to manage an account and those kinds of things. So those are basically built just on like allowance basis. But one of the cool things that the card does is it allows them to buy stocks, and it allows them to buy partials stocks.
Yes.
And so he has gone out and he's looked at, okay, Roblox, video game type stocks that he's invested in, and he keeps track of them. And, it's so cool when I'm talking to my teenager who doesn't even have a job yet. And he goes, man, did you see the market today?
Yeah, wow, yes. Well,
so yeah, there are a lot of opportunities for just jumping in with just a little bit of capital.
yes, and he's learning the risk and rewards of investing.
Oh yeah, and he knows that it's a longer game thing.
Correct. And he can even be learning, the excitement of investing versus spending. We like to spend money, yes, typically, but there is an excitement of putting money aside, not spending it on that, whatever you want.
And that's how my kids are different.
And then it grows. Yes, that's great.
That's how the two of them are incredibly different. I'd like both of them to understand the joy of investing and seeing returns.
The excitement that comes.
And for my daughter, the excitement comes from spending it as quickly as it comes in.
Oh yes, well, and then we got to give a little more guidance to some on making sure that they can enjoy life throughout their life, not just today.
Yes, exactly.
But other components of investing are making sure that you have well diversified assets. I mentioned the term dollar cost averaging. So those are things you want to consider.
So let's talk about diversification. It's a big word.
Yes.
We've talked about it before, but let's define it. Let's talk about what that looks like and why we want to diversify.
Okay. Yes. So diversification is, and I'll define it specifically with investing, is investing in different assets. The word diversification is you're differentiating, or you're putting things in different buckets or different assets for your investment account. The reason you want to do that is because, as we've experienced in 2022, the stock market went down. Stocks and even bonds went down in 2022. That as values go down, you want to have money or assets in other things that didn't go down.
Yeah.
Bank accounts didn't go down. That's in simplistic forms. That is diversification too. Just cash. Cash didn't go down in value. People have money in insurance products. Most insurance products didn't drop in value in 2022. Real estate values didn't drop. I mean, that's diversification. So the idea is that you invest in all different types of assets for the different economic factors that affect us throughout the years as you're investing. Now, the longer term your goal is, like retirement that we spoke about, the more diversified you could be. The shorter term your goal is, maybe the less diversified you may be, being that you have to try to minimize risk.
As long as you understand what field you're investing in, because,
Correct.
I just go back to my son. If he's only investing in gaming and something impacts that,
yes,
then everything, goes away. We saw, some markets did much better during COVID than others.
Correct. That's correct. Even within the stocks or the mutual funds that people generally invest in, there are hundreds and thousands of different companies in different sectors of the economy. Healthcare, for example, in some areas of healthcare did better. And then there's financial services, there's commodities, there's durable goods. I mean, there's lots of different types of things that you want to be invested in. So you're investing in a wide variety of companies as part of the assets. Another thing that you prompted me, that thought, I remember several years ago during our, I'll say the previous financial crisis we had in like 2007, 8, 9 time frame, it was very common for clients that I met with that no matter what field they worked in, I'll use Intel as an example. So they had their 401k at Intel, all in Intel stock. And then their outside investments were all in Intel stock. And then their job was based on Intel. Yeah. Now, I'm not saying Intel was bad or good or, anything, but, if Intel took a dive, not only did that affect their job, that affected their outside investment, that affected their 401k. And that's an example of not being diversified. So you don't want to own, just gaming stocks as your son. Maybe right now it's okay because he's taking a bigger job.
That's an excellent point because, if your company is giving you stock options and you've got that, then it's probably not the best solution to invest the rest of your, what you are going to invest normally in the stock market in the same company.
That's correct. So you want to
enjoy those stock options,
yes,
but diversify it and get something in a completely different market.
That's exactly right. So not everything's based on that one company or one sector of the economy. That's correct.
The Klaus team is different. With the Klaus team, you have someone on your side. Where you live and make memories is important. We have more unique strategies than anyone else to help you accomplish what matters most to you. We can help you with traditional real estate as well as other options such as our lease purchase programs. We can help you buy first then sell, and we can bring you instant offers. We're here to help our neighbors achieve the American dream and help them build wealth through home ownership. For more info or to start your home search, visit us online at klausteam.com. So let's talk dollar cost averaging.
Yes, I mentioned that term when I was talking about investing early and investing often. So the often part is what dollar cost averaging is. The benefit of dollar cost averaging is because, and I'm going to use stocks and bonds and mutual funds as the example here, but values of things, even real estate for that matter, fluctuates. Mm-hmm. Stock goes up, goes down, stock market goes up, goes down, mutual fund values go up, go down. And if you're only investing one time a year, you don't know whether you're investing at a high point or a low point. Mm-hmm. And so the reason dollar cost averaging is beneficial, if you're investing like on the 1st of every month or the 15th of every month, or just periodically you're putting in every month, as the market goes up and down, you're going to be hitting several down points too, and you're going to be buying at a discount throughout the year. It removes emotion. And study after study has shown that people that dollar cost average and invest on a regular basis typically do better over time because they're buying low when they're not having emotion involved in it and they're just putting it away. There's also a secondary benefit to dollar cost averaging is the fact that when you get in the habit of saving and you do it periodically, you continue to save. Mm-hmm. Those that save once a year almost invariably will stop. Statistics show that they'll stop certainly sooner than the one that's doing monthly because you forget.
Yeah, you forget. It becomes
January
part of your budget.
Yeah, exactly. So if you're doing it monthly, most people are going to save more over the long period of time. And then I guess the term I didn't necessarily define, but dollar cost averaging means you're putting in $1 every month at the same point every month, and the average cost of whatever that asset is, stocks or mutual funds, that average through the year is usually lower than if you're buying it one time a year. And that's what the term actually means. But it does help, and it keeps people in the habit of saving or investing.
And it helps recover a little bit if you bought some stocks that are at a higher price and they've declined.
Yes.
Then the stock target does not need to be as high for you to see positive gains.
That's
if you're
correct.
Buying stocks at a lower price.
Yes. And 2022 was a perfect...
You can buy a lot more stocks at a lower price too.
Yes, you can.
And offset those higher. You're like, oh man, I shouldn't have bought so early in this stock, and then, I can get them now when they're much smaller and bring that cost per share down.
Correct. And I was just mentioning 2022 is a perfect example of that. For those that maybe invested at the very beginning of 2022 in January, when the stock market was at an all-time high, or at the very, very beginning of the year, purchased at a higher price, and then they saw that value of that account dwindle throughout the year, and they require more, a substantial jump to recover that loss, whereas somebody that's investing throughout the year, January, February, March, April, May, they were buying as the stock market dropped 20-30%, they were actually getting a 30% discount on their purchase. So as the stock market has been recovering, it didn't take as much to recover back to break even on their account. And that's another benefit of just doing it consistently every month is my recommendation.
So how does somebody decide how to invest?
So the how, again, is going to depend on the goal. And so we'll look at the goal. If you're working with a financial professional, they'll help determine, what you should invest in. But the how is really getting an account set up, and we should set that account up based on your goal, where it needs to be, how long it needs to be invested in there, and then it's as easy as going online and setting up an account, or talking to a financial professional and setting up an account. With as little as, I think as we mentioned, as little as $50, most accounts can be opened, and you can be on your way to saving every month.
So what is the difference between people that work with a financial advisor on these kinds of things, or just go and open up a Robinhood or a TD Ameritrade account and just poke their finger in and start trying things out?
Yes, I'm going to be a little partial as a financial advisor myself. Working with a financial professional, I think is going to the potential to have superior results is there. And there are studies out there that show those that invest on their own versus using a financial professional may, have a significant difference in their outcomes because two main reasons. One is determining what to invest in. When you're investing on your own, emotion, we may not think that emotion's going to drive our decisions, but it does. It drives our decisions, a lot of decisions, and especially in investing. People that invest on their own and don't have a financial professional working with them typically will pull out of the market, at the wrong time, go back into the market at the wrong time, and may end up choosing the wrong investment or combination of investments to get into.
Oh, but I read an article on this stock, man.
And there's so much, actually now more than ever, a financial professional is going to be helpful because there is so much information out there. It's actually, the more information there is, the harder it is to do whatever it is that you want to do. And that goes for anything. It doesn't even have to do with investing, but just, as a real estate company, as a real estate broker, you people that are out there making a decision to sell their home on their own, statistically probably don't get as much or make the right decisions if they don't have a real estate professional giving them guidance on the timing and the how and the what and the when. And that makes a big difference working with a financial advisor.
Well, thank you so much for clarifying all that stuff. If people want to connect with you, what's the best way for them to get a hold of you?
Yes, so you can contact me a couple different ways. Again, it's Michael Klein. Last name is Klein, owner of Klein Financial. And you can call my office at 480-981-1333. Or you can catch me on my website, www.kleinfinancialllc.com. And again, Klein. I also have to finish with a disclosure, make sure that I'm staying compliant, but I work through a brokerage firm called Woodbury Financial. They're my broker-dealer, and I do need to mention that securities and investment advisory services offered through Woodbury Financial Services, Inc. They're a member of FINRA and SIPC. Insurance services are offered through Klein Financial LLC, which is not affiliated with Woodbury Financial Services, Inc.
Thank you so much, Mike.
It was a pleasure to see you again, and thank you for having me on.
Thanks for spending time with us this week at State 48 Homeowner, the ins and outs of owning an Arizona home. You can connect with us for more information, submit topics you'd like us to further discuss. You can see relevant videos, give us feedback, answer your real estate questions, and more at state48homeowner.com.